Welcome to Telltales. I'm Mike Nicoletti. Every week, along with my co-hosts Jason Wallace and Hunt Lawrence, we bring you the Cash Flow Memo. Get it at telltales.us. For the next 30 minutes, we're going to dive deep into energy, technology, and healthcare. So download the memo now and get started.
The following conversation is intended for informational purposes only. You should always do your own work to determine if an investment is suitable for you.
Ready to start. Exhibit C will change if there's a ceasefire between Ukraine and Russia. The Russian production, which has been declining, will flatten out. They produced 10 million barrels a day in 24, and that was down in 25 and is projected to be down in 26 to around 9.2 million barrels. The way to think about it, I think, is that in OPEC Plus, Saudi Arabia, which was 9 million barrels a day in 24, will be 10.5 in 26, and half of that increase is made up for by the decline in Russia. The other supplies, other OPEC Plus, other crudes, all pretty much flat. The U.S. in 26 will be down, and the estimate here is 12.5 million barrels a day for average for the year, down from 13. And that looks like a pretty good prediction based on the rig count and the count of frac crews. And so between the U.S. declines and the Russian decline, that makes up for the Saudi increase. Everything else is pretty flat. I mean, the UAE, Abu Dhabi is up, Iraq is up a little, but the result is that supply in 26 is up very slightly from 25 by about 400,000 barrels. I think that's a reflection of oil pricing being 60, and now WTI is now trading a couple of dollars below 60. That will have an impact on supply, is having an impact on supply. The problem with the reason that addressing the supply-demand imbalance will take longer is when we get down to the demand tables. The U.S., rest of North America, Europe, Japan are all flat in demand, and they have been flat for a number of years. It appears to be the case that mature economies get to the point where oil demand flattens out. China, which has been in the 23, 24, has been growing. 25 was down a little, 26 is down a little, is really gotten flat like the other economies. So if you go back to 23, 101.8 versus 994, that's a pretty healthy interest, 1.4. And then in 24, 1029 versus 101.8, that was up 1.1. In 25, 1034 is up only 500,000 barrels from 24. And the prediction for next year is up 700,000 barrels. What's missing here is that China, which is the second largest consumer of oil. We're in the U.S., we're 20 million barrels, Europe's 14, China's 16. These big users of oil are going to be flat, and China is just not growing anymore. Their economy's still growing. Of course, they put enormous resources into battery cars, and pretty high portion of the new registrations every year are battery cars. So for oil demand growth to help with addressing the supply-demand imbalance in oil, reliant on India. But India, even though its population is equal to China, a little more than China, consumes way less oil. Next year, 16 million barrels from China, 6 million barrels from India. Some of the other Asia is growing, but not by more than 200,000 or 300,000 barrels. The Middle East grows a little bit every year, but the source of growth. To project more than about 500 or 600 or 700,000 barrels of growth, even with lower prices, which should encourage growth, just seems unlikely. So how long will $60 oil or sub-$60 oil last? Normally, in the past, you'd say 12 or 18 months. But with the reduced growth rates, especially from China, as China's gotten mature, what you might say 12 or 18 months of lower oil prices would get rid of the supply and you get back to more of a balanced market. I think you have to conclude that you're probably talking 24 to 30 months. It will eventually happen. $60 Brent or $58 WTI is not enough to keep supply from declining on a worldwide basis. But it'll take a while because of the lack of growth in oil demand. When we turn to Exhibit D and we start focusing on natural gas, the remarkable thing about natural gas is the growth in supply. I mean, if we had something like this happen in the oil market, the oil would be, I don't know, $30 or something. But look at the production demand 2019 to 26. Supply has gone from 93 Bs a day to, in 25, it's 112 and 115 in 26. Now, some of the supply is Canadian imports, and Canadian imports are up by about 2 Bs a day. But most of the supplies come from our own dry gas production, from just under 89 billion feet a day to, in 26, projected 108. And then look at the table above. When you look at the 16 Bs a day from 21 to 25, 2/3 of it has been from the Permian. Now, that's associated gas in the Permian, so it's not really impacted by price. If we go down to production demand 2019 to 26, you can see the gas price, average gas price is all over the place. $2.70 average for Henry Hub in 2019, $2.20 in 2020, $3.70 in 21, and then with the impact of the Russia's invasion of Ukraine and the possibility of Russian gas being sanctioned and very high LNG prices, it went to $6. Then back to $2.75 in 23, $2.40 in 24, $3.60 in 25. I mean, this is pretty volatile. And the futures curve is like $4 in 26. Despite that volatility, gas supply just marches up. Well, when you consider that 2/3 of the increase in the last 5 years has been from the Permian, which is associated gas, which really has nothing to do with the price of gas. It has everything to do with trying to produce the oil, because the gas is produced along with the oil and then separately processed and sold. The supply is just something we have to deal with. Many categories of demand here are pretty flat. Like industrial demand in 2019 was just under 23 Bs, just over 23 Bs, estimated 26. Residential commercial was 25 Bs, again, about the same in 26. Exports to Mexico are up a little. Pipe loss is pipe loss. What we've relied on is power demand, which has gone from just over 30 in 2019 to 38, and LNG, feed gas, which is just under 6 in 2019 to 17, projected for 26. Now, power demand is pretty reliable, we think. And LNG, you can kind of predict LNG feed gas by seeing how many LNG facilities are being constructed. So the Trump administration has pretty much approved every application to construct LNG. Now, LNG plants take, better part of 3 years to construct. So we can predict, I think, with some confidence that LNG demand will be up in 27 and 28, just based on what's being constructed. We hear all this publicity about data center demand for power, And it always seems to come down to natural gas, and hopefully that'll help. The natural gas demand for power in kind of an alarming way is kind of flat 25 versus 24. But the statistics there seem to indicate, first of all, the summer was a little cooler than normal and the winter wasn't as cold as would be ideal on a full 48 state basis. We think power demand will continue to increase. We think the Trump administration encouraging coal plants to remain in operation is part of the reason there was slow demand in 25. So is $4 in the futures curve, is that sustainable? Sure hope so, but just consider as an investor in upstream companies how darn volatile that price of natural gas is. Exhibit A, healthcare is going to be the headline because the Democrats think they've found an issue, which is the extension of these tax credits for 20 million of us that are getting subsidies that were started during COVID. Of course, we had the longest shutdown, 40 days. That's been deferred, so we have until the end of January to come up with a solution. Part of the Democrats crossing over and joining the Republicans to end the shutdown was that they'd be able to write a bill that would get a Senate vote in, I think, by December 15th. So this is very much going to be in the news. We have reduced our deficit or at least forecast in 26 versus 25. And I think there's a prospect for reducing the deficit somewhat in 27. It would enormously help if we could have Medicare and Medicaid flatten out a bit. And of course, that's what's being debated. The defense seems pretty set at around $900 billion. Because of all the deficits, the interest cost is remarkable. I mean, if you go all the way back to 2018, the federal government paid $330 billion for interest, and the fiscal year we're in, it's going to be $1.1 trillion. Now, interest rates do seem to be set to come down. Certainly, the Fed funds rate looks like there are enough Fed governors announcing that they're going to support a quarter-point decrease in their December meeting. So that seems assured. Good question is, the Fed funds rate coming down, what will the impact on the 10-year bond? The 10-year bond doesn't necessarily come down quite as quickly as the Fed funds rate does. It's more a matter of supply and demand. Now, our Treasury Secretary, Scott Bessent, is going to keep all the borrowing real short. And the Trump administration is going to be able to name a new Federal Reserve chairman to take office in May. Your 10-year bond, off which mortgage rates are set and corporate borrowing rates are set, probably will come down some, but they don't have the same capacity to reduce the 10-year rate that they have to reduce the Fed funds rate. I hope I got enough there to keep Jason happy, so we can move on to our 10-minute segment, which in advance, I don't want to brag or anything, but I think what Mike and Jason have put together on the next topic is just over the top good. And you'll remember last week we promised we think that there's some long-seated disagreements or enmity between NVIDIA and Apple. And with that, we'll turn over to Mike and Jason, and they'll explain how that happened and how it continues.
When people talk about the bad blood between Apple and NVIDIA, they almost always point to Bumpgate, which was a 2007 defect where NVIDIA GPUs caused thousands of MacBook Pros to fail. And that was a big deal. But I always thought that was sort of like a relatively minor deal in the grand scheme of things when it comes to their relationship and why that would actually cause it to fester on till today. But if you zoom out, I don't think that's the real reason Apple continues to hold a grudge against NVIDIA. The real break wasn't about the broken parts. It was about control. And I'm going to break this down, but it was a war between commoditization and differentiation, specifically within the GPU. This is a war that NVIDIA ultimately won, Apple lost, and the entire construct of the AI era reflects that outcome. So let's break down this story, and I'll actually tie this to the way that Apple's made the decision to use Google Gemini to power Siri. So for this story, you have to go back to 2008. At this point, NVIDIA had launched CUDA, which we've discussed on this podcast before. NVIDIA realized the GPUs weren't just for graphics, but you could actually use a GPU for certain types of compute, specifically massively parallel computations. So this proprietary software development language, CUDA, was their bid to lock in a bunch of developers into working on NVIDIA hardware. So at this point in time, Apple was putting NVIDIA GPUs in their MacBook Pros. And Apple eventually came to the realization that if CUDA won this, NVIDIA would own the platform for GPU computing, and Apple would be essentially IBM in the early PC era, where Intel and Microsoft really captured all the value.
I guess I would just add a key thing is at this point in time, the MacBooks were used primarily by creatives. So they were editing videos, photos, generating music. A lot of software engineers were using it to design web pages and the like. So graphics were a big part of the cell.
Right. And it wasn't, remember, this was way before Apple Silicon. So Apple was using, at this point, I think an IBM PowerPC chip. So early Apple days. So Apple made a strategic move that we've talked about before, the concept of commoditizing your complements. So if you can make something that makes your product better, a commodity, then you will capture the value ultimately from that. So the logic's pretty simple. Apple's product is the Mac. The GPU is a component of that Mac. So to maximize profit for Apple, you want the GPU component to be cheap and interchangeable. So that led them to start a internal project called OpenCL. And OpenCL was a language designed to be a vendor-neutral software layer that would run on any chip, NVIDIA, Intel, AMD, for the purposes of GPU-type computing. It actually, eventually, I don't know if in the beginning, was able to actually be used for CPUs as well. But with the hardware becoming a commodity, NVIDIA would become like an undifferentiated commodity player, and Apple could pit them against Intel and AMD for GPUs. So for the first few years, it seemed like this was working. Apple did shift to AMD as a supplier, but NVIDIA really fought back against the commoditization of their products. So in order to kind of fight back against that, there were kind of three distinct things that stuck out as to how Apple wasn't able to match it with OpenCL. The first one being the software libraries. So where maybe Jason could explain this better than me, but a library would be like a collection of software that does something all in one block. And you could basically pull it into a software program and it's ready to go. And some of the popular early libraries were for linear algebra and some other types of compute. And whether you're a researcher or a software developer, if you don't have to reinvent the wheel every time, that's a good thing. So CUDA had the best software libraries, so the researchers naturally gravitated towards CUDA. The other thing NVIDIA did that was really distinct is they flooded universities with free GPUs. And this was a good long-term play because they created a generation of PhDs who all worked in CUDA. There was no incentive to go learn OpenCL or any of the other languages that came up. And then finally, when the AI boom ignited in 2012 with AlexNet, which we discussed in previous episodes, it was trained on CUDA. So that was sort of the shot heard around the world in the AI world. And since that was built on CUDA, everybody looked at that paper and all iterations on that, again, were built on CUDA. So by 2014, NVIDIA had really decommoditized the GPU. And And frankly, Jason and I were building a software company at this point in time and working with a bunch of people that were building computer vision models. And literally everybody was using a NVIDIA GPU. Distinctly, one company was given free AMD GPUs, and rather than actually use those for programming, they instead used them for Bitcoin mining.
And then bought NVIDIA GPUs.
And then exactly. Yeah. So the light bulb moment is that really they weren't selling a chip; they were selling a standard, a development standard for a new type of computing. So Apple's response to this was to retreat into vertical integration. They realized they couldn't rely on open standards, on OpenCL. They actually ended up turning over OpenCL to AMD and Intel and a third-party independent standards board. And what they did is they built Metal, which is their proprietary software, and Apple Silicon, which we know and is more well-known as their proprietary hardware. And this created a closed loop in which NVIDIA owns the horizontal layer in the cloud and Apple owns the vertical layer on the device. So they sort of play in their own areas and don't touch each other. And that seemed to be pretty much a stalemate. And then the AI era kind of came to be, and everybody realized that Siri was not good enough. And as we've heard in the last few weeks, Apple is partnering with Google, paying about $1 billion a year to put Gemini inside of Siri. So, looking back, if Apple's move into vertical integration, you might ask, if Apple is so obsessed with owning the whole vertical stack, why are they renting a brain? Why are they using an outside model from Google? And I think in a way, this actually proves their strategy. It goes back to commoditize your complements. Apple's bet is that general knowledge, or as we think of AI models, are a commodity. So, knowing the capital of France is generic information. You can get that from Google or OpenAI or Anthropic, but personal context is actually more of a moat. So knowing your calendar, your location, your emails, that is kind of more proprietary and kind of fits for Apple. So Apple's sort of splitting the stack. They get the personal layer that runs on a device, the Apple Silicon, totally private, totally Apple. And by having Gemini run inside of their servers under their control, they're able to outsource the actual model development with, and the assumption here is that they could remove Gemini and plug in something else, Anthropic or OpenAI. So by partnering with Google, Apple's funneling cash to the only cloud provider that builds its own chips, the Google TPUs, rather than buying NVIDIA's. Apple's had their own AI projects, which haven't really gone that well. But what we know about them is that they were actually using TPUs for training them, actually bypassing NVIDIA's ecosystem entirely. So where are we today? Apple's got a world-class AI in their ecosystem. They keep their vertical independence, and they do it through the only company on earth that's not using NVIDIA for their AI. The feud started not because of bad solder bumps in 2007, but the bigger picture is about competition for the control of GPU computing. This feud hasn't ended. It just moved from the motherboard to the data center.
Yeah. And next week we're going to do, since Google's had this big recovery, next week we're going to do 10 minutes on Google, or recent Google, because everyone kind of gave up on them when AI models came in. They felt that the search monopoly would be substantially diluted, but that isn't necessarily the way it's come out. I think that'll be our 10-minute episode next week. I'd like to, in referring to page 1, 2, 3, and 4, just point out that if we're keeping track of it like an athletics contest, at least as of last weekend's pricing or last Friday's pricing, NVIDIA was in the lead at $4.4 trillion, but Apple's getting closer at $4 trillion, and Alphabet, which was considered to be the victim of the AI development, is 3.6, with Microsoft at 3.5. So this is very topical, and I know a lot of the people listening own these stocks. There is a case that things are overvalued, a bit of a bubble, but the strength of these Mag 6, let's leave Tesla out, which is so controversial, is quite remarkable. I think for the next few weeks through year end, we'll focus our 10-minute episodes on the relative strengths here. But this situation that the way Apple's handling this could come out awfully well for the Apple stockholders, I think. Before we run out of time, we've got to do some healthcare. Jason, news or developments on our favorite companies or anything else in healthcare to be noted?
Yeah. So in Vertex's case, the non-opioid pain treatment, Genavix, the prescription data is showing steady growth. On the research front, as we know, their follow-on next generation molecule did not outperform the current one, but they had some encouraging statements at a conference recently when they're talking about targeting the other nerve channel that transfers pain signals. So first they said that selectively inhibiting that channel is much harder, but they've also discovered a new novel binding site that they're really excited about. They're finally starting to talk about it because it's transitioning to clinical human testing. Other news is Eli Lilly on page 19. As it relates to PBMs, they as a company internally have dropped CVS Caremark as their PBM, and they're using a smaller one called Rightway, which has a few other pharmaceutical companies as clients, but their value proposition is they're a neutral party. They're actually acting as PBMs were designed to do without conflicts of having the insurers and the incentive to inflate drug prices. Some news out of CMS is they finalized a planned rule that they're going to potentially implement that moves towards more site-neutral payments for drug administration. And what that actually means is closing a loophole that hospitals currently use to charge CMS in-hospital rates when the patient actually visits an outpatient surgical center. We know hospitals charge, many multiples of what the outpatient centers charge. So this was a way to boost revenue while having a lower cost provider within the hospital network. And one of the main ways they take advantage of it is administering chemotherapy in these outpatient settings, which really drives up the cost of cancer care. So I think this is maybe the first one, and if it works, CMS might look towards closing other billing loopholes the hospital uses to charge higher rates to Medicare. So potentially good news on cost savings there.
Mike attended a Cold Spring Harbor event where the head of Moderna was a keynote speaker. This is page 15. To me, Moderna has gone through the cash it earned during COVID, being a direct provider of COVID vaccine, whereas BioNTech, in partnership with Pfizer, accumulated a lot of cash too. But if you look at the net debt line, as of the third quarter, Moderna is down to $4.5 billion of cash. BioNTech still has $14 billion. Here, what both companies were working on before COVID was described as cancer vaccines. With that, let's take a remaining couple of minutes just to explain what the term cancer vaccine means as Moderna and BioNTech say their role in the world is.
Yeah, we've gone back and forth of whether it should be called a vaccine or not, if it's a treatment. So we've done a lot of research on it, and where we sit now and the way we see the future is you're going to have a variety of cancer treatments. Part of your journey through cancer treatment will be sequencing the cells in your tumor, figuring out the exact profile of it, creating some tests around it, but also creating a personalized vaccine that then post your kind of acute treatment, you'll have this vaccine that will prevent reoccurrence. It'll prime your immune system to look for that mutation to occur again that would trigger the growth of cancerous cells, and your immune system will be able to clear them out before they become a problem. So that's kind of how we think about it. And these two companies specifically, interestingly enough, 3 years ago, they both had a share price around $180 a share. Today, BioNTech's at 100, Moderna's at 25. That kind of highlights the contrast between them. You mentioned the burning through their cash reserves. BioNTech spent maybe 10% of their cash reserves, whereas Moderna at this point spent more than 60%. And interestingly, the interest that BioNTech earns covers half of their operating losses at this point.
Mike, do you want to speak up for Moderna, having recently heard its founder speak in a more or less, sophisticated forum of investors and scientists?
Right. Well, that talk was mostly about basic research, but I did get a chance to speak with the co-founder and current chairman of the board, and it's very optimistic about the outlook for personalized cancer vaccines. About the COVID era, it was very unique that BioNTech was able to strike a deal with Pfizer. And whether something like that could be replicated in the future or not, I don't really know, because I think in most other situations, the company would have just been acquired. So I don't get the impression that option was on the table from anybody when it comes to Moderna. So if they were forced into commercializing all on their own and didn't have a partner, that was a lot of expense that they were going to have to incur. But it does seem that have not throttled their spending as quickly as they ought to have. And I think that goes for everybody in the post-COVID era, is the recognition that this is a season and that season is over.
More on this next week. We're now past 5 minutes after the hour. We want to wish everyone a happy Thanksgiving, and we'll be back here exactly 7 days from now. Everyone be well and stay healthy. Thanks very much for listening. Take care.
The views expressed on this podcast are the host alone and do not constitute an offer to sell or a recommendation to purchase or a solicitation of an offer to buy any security nor a recommendation for any investment product or service. While certain information contained herein has been obtained from sources believed to be reliable, neither the hosts nor any of their employers or their affiliates have independently verified this information, and its accuracy and completeness cannot be guaranteed. Accordingly, no representation or warranty, expressed or implied, is made as to, and no reliance should be placed on, the fairness, accuracy, timeliness, or completeness of this information. The hosts and all employers and their affiliated persons assume no liability for this information and no obligation to update the information or analysis contained herein in the future, and may or may not hold positions in the securities mentioned.